Hello, today is December the 18th, 2015. Yesterday, the Federal Reserve decided to raise the interest rate 0.25% for the first time in I don't know how many years. I think it's been like 7 years that they've had 0% interest. And the real estate boom is coming to an end. Stay tuned. So I'm hearing some rumors now that the Federal Reserve has raised the federal funds rate to up 0.25%, that this could be the end of the real estate boom that has started in 2012. And I'll be honest, I hear the rumors about the shift coming. I just don't see it yet. I know that when interest rates go up, that usually slows down the real estate market. That certainly can be the case. But here's what I think is happening. One, just because the Federal Reserve is raising the interest rate 0.25% doesn't actually have a direct impact on mortgage rates. They don't actually set the mortgage rate. What that is the federal funds rate, which is the bank lending rate between banks. So it does somehow affect mortgage rates. Bond rates actually affect mortgage rates. The liquidity of the mortgage market as far as mortgage-backed securities being bought affect mortgage rate. So there's a lot of things that go into the actual mortgage rate. But even if we see the mortgage rates come up a little bit from where they are, my personal opinion is that's going to allow lenders to actually lend to more people. Because let's face it, at the current interest rates that they are charging on loans, let's call it 3.5%, 4% in today's market, a lender can't really make that much money on that loan. And therefore, they have to make sure that that person is really do a good risk assessment, make sure that that person can pay back their loan, and be very tight with their money because there's very little margin for error in that type of loan. The higher the interest rates go up, the more of a chance that they can take a little bit of a chance on somebody that might have some marginal credit. I'll give you a perfect example. If you go do a car loan at a car title place, they don't verify anything. They just take your title, give you a loan. But it's at a very high interest rate. That's the reason they can actually make that work. So I think what is going to happen is, it could slow down a little bit of the buyer activity if they continue to raise interest rates. Again, 0.25%, I really don't think that's going to have much of an effect. But let's say over the next 6 to 9 months, somehow they raise it up a total of 1% from where we are right now. Could that affect the buyers that are currently in the market slowing down? Maybe. It might push some buyers actually off the fence to get them moving forward, knowing that the rates are going up for once. But let's say that it does slow those buyers down. If it also has the inverse effect that lenders are able to loosen up their standards a little bit and let some more people into the mortgage pool, then we'll actually have the same number of mortgages either way. Now, I'm not hoping that we go back to a no income, no asset verification type loan scenario like we got into when we hyperinflated the real estate market in the last upturn. But, honestly, I believe we're probably going to do that. I don't think we actually learn from our mistakes. I think as long as there is a desire in the market to buy mortgage-backed securities, that lenders are going to find more and more ways to get more people into the pool so they can lend more money and make more money for the bank. So I don't think 0.25% is going to make that big of a difference. I could be totally wrong, but I'm going on the record today saying that I think it's going to be fine.